Now I would like to bring on Ben to talk about Gresham House Energy Storage. Just to give some context, Ben has been Managing Director and Head of Gresham House Energy Storage Transition Division since November 2017. Obviously, he's the fund manager of Gresham House Energy Storage and was, until 2020, also fund manager for the British Strategic Investment Fund, which was the BSIF strategy, and sort of grew AUM to 350 million under his leadership. As I say, there's more on Ben's career, but he's obviously got a distinguished career in this space. So, Ben, for the people that perhaps a bit less familiar with the fund, could you just perhaps spend sort of 10 minutes or so just talking about how the fund works, what the strategy? Just give us an explanation of how you make this work.
Fantastic. So landing page, powering the renewable energy transition. Batteries are obviously essential for this, or energy storage more generally. The picture you see on the opening page is one of our recently concluded sites, Shilton Lane. If we jump to page 3, and I'll take you through the slides fairly swiftly. So what is the Gresham House Energy Storage Fund PLC, which we nickname GRID due to its ticker being GRID, trying to do? Well, we're essentially trying to create scale in energy storage in the UK. We are the largest fund investing in utility scale battery storage in Great Britain. So we don't invest in Northern Ireland at this stage. We do have the potential to invest internationally, and we will of course revisit that when things stabilize here in GB. We've reached our next level of scale that we have ambitions to achieve. So how do we, we seek to create value really from investing in incremental capacity, in scale, units of megawatts or megawatt hours, which is the battery capacity behind a unit of power, which is a megawatt, and maximizing the revenues per unit of capacity. That's ultimately the simple story, how our top line works from a revenue perspective. Going to the next page, page 4. Let's break that down a little bit more. We're trying to sort of grow our NAV and grow our EBITDA. How do we achieve that? Well, by investing in projects with strong initial returns, and for NAV purposes above the weighted average discount rate, means that when we go from valuing these from cost to a net present value basis, the NAV has an opportunity to move upwards. Then we've been reinvesting quite a lot of capital. So NAVs by definition, just look at the cash flows from the existing capacity. We're actually reinvesting capital and trying to grow the installed capacity to then grow the NAV and EBITDA of the business. So that allows returns to compound. And then we can also try and add value to projects through doing additional things to them, extending their project lives, augmenting them, and so on. And then, of course, Matthew, you've been very clear about the issues in the sector. We're trying to drive revenues through the improving or strengthening market, and we've got some updates on that. And then also new revenue streams as well, which are part of our 3-year plan, which I'll come on to in a second. So our aim is to remain number 1 in GB, and to use our scale to our advantage, and in particular being the lowest cost provider. So how are we doing that specifically? The 3-year plan that we've announced a year ago now, just under a year ago, is to grow our capacity from the gigawatt level that we're at now, 1,072 megawatts to be precise, by building 694 new megawatts and adding additional batteries to our existing gigawatt of capacity. All of that will overall double the installed capacity of batteries that we have capable of earning revenues over the next 2.5 years or so. Then we do see additional revenue opportunities. The way batteries have been traded so far are through things like frequency response, wholesale market trading, the balancing mechanism, things that people have heard about quite a lot if they're familiar with the sector. We believe that there's additional ways of making money from our batteries. We've been quite coy about this. It's obviously commercially sensitive, and we do look forward to saying a lot more about that. And then, of course, the system improvements in the market should drive better utilization. I'll come on to that specifically. So if we go on to the next page, just recapping first in terms of where we are as a business. This is a snapshot of our first half results, which came out about a month ago now. We've in the first half, got the historical construction program completed. We've got the portfolio up to 1,070 megawatts and about a 1.6 hour duration behind that. So that translates into 1.7 gigawatt hours or 1,700 megawatt hours of battery capacity. Of that, moving down, about half of that is contracted, and that's actually going to increase. About 90% of it will be contracted once all the contracts are in force. And that will longer term be through what we call floor contracts, which basically guarantee a minimum level of revenue, which is guaranteed by our counterparties over several years, all of which are investment grade, and therefore supporting the lending facilities that we have in place. Moving to the right-hand side, on the right-hand tiles, you've got revenues showing strong growth, partly through increased capacity, but mainly through that revenue rate, unit revenue rate improving, as we've seen an improvement in the utilization of batteries, but there is a long way to go. And of course, EBITDA grew even faster because there's a slight leverage effect as well. So moving to the next page and being more specific about our 3-year plan, we've got the groundwork completed, the completion of our construction. We've concluded a refinancing of our portfolio facilities. We've upsized that facility. It isn't costing us a lot more because we're going to be able to borrow, or we are borrowing at lower cost now. And we're also going to use that capital to reinvest in the augmentations that we've announced. And those augmentations, which are now underway, by the way, and will largely conclude by the middle of next year. So we're well onto that program. And that means that obviously drives better overall returns and decent coverage of the debt. And then the equity capital has been raised through this exercise as well. And then there's an extra financing exercise to provide the senior financing facilities for the new projects that we're building, the 694 megawatts. And that should get those projects into construction towards the end of this year, beginning of next year. And then we're on our way, waiting for those projects to be completed and then driving the upside in earnings potential. We've announced, as part of our latest announcement as well, a reinstatement of our dividend. Because of our growth focus, it is a very modest dividend at this stage. But then once the growth has been achieved and the cash spent on that increasing capacity comes down and tails off, the free cash flow for the business should expand. And I'll touch on this now. So capital allocation, essentially on the left-hand side, just slightly repeating, but reiterating that we've got to focus on growth. The current plans are for 345 megawatt hours of augmentations on the existing portfolio, 694 megawatt new pipeline. That gets us to 1.8 gigawatts at an average of 2 hours, up from the 1.1 gigawatts and 1.6 hour average duration. All of that work that we're doing will not see our debt explode. We will maintain our debt below 50% of NAV. It's a really important message, I think, because it's quite significant growth, but we're achieving that well within our investment policy limits. And then on the right-hand side, first stating that all our dividends going forward are going to be not just covered by cash flow, but free cash flow after capex, after PLC costs, after debt service, and so on. All costs, essentially. So the dividends therefore start small, given that we're trying to maintain full coverage and using sensible and conservative assumptions while making that assessment. There is always potential for more, but should there be excess cash flow, the board will consider that. From 2027, the capex starts to peak. The more of the capacity is online, that will complete in early 28 in totality. But essentially, capacity starts to grow, capex starts to peak, and the dividend potential starts to grow. Now, we provided a sensitivity in our last results, which is to say that if the approximately current merchant revenue level, in other words, the more uncertain, volatile stream of revenues was set at 75,000 per megawatt per year, which is roughly the level we're at now, and that capacity earned at that level, the free cash flow, again, after all costs, PLC, dividend, debt service, PLC costs, I mean management fees, debt service, and any remaining capex, the the free cash flow would be 10p. That compares with a share price of about 71p today. And of course, we hope, I suppose, that the recovery in market revenues comes through. The curves, the revenue forecasts suggest that we should really be at over 90 in 28, 29. And that would, should that sensitivity come about, take the free cash flow up another 5p, just as a sense check. And then, of course, the potential for buybacks is there as well, should free cash flow emerge for that, and is always being assessed given where the share price is. On the next page, I think this is sort of a catch-all storytelling of the business. What you have here is the monthly revenues of the business in absolute terms, in pound terms, annualized, expressed in annualized terms. So it's like, if you take any point along the thick blue, light blue line, you can assess what the annualized revenues are in that month. And as time goes by, there is an uptrend, of course, in 21 and 22 due to the very high gas price environment, also due to various scarcities from frequency response perspective. We were earning well above our third-party curves. Then we saw that as we migrated towards having a trading strategy away from frequency response, which is a time-limited opportunity, it's not a huge market, we realized that the skip rate topic emerged. We suffered our weakest moment. We unfortunately had to cut our dividend. We've restructured the business to be able to weather downsides like that through the floor arrangements. We've refinanced our debt to have the freedom to operate and to grow now. And we look forward to executing on that growth plan. What that should translate into, if you were to extrapolate this chart to the right, is that the megawatt capacity should go up from the current 1,070 to 1,800 or 1,766 to be exact, based on the capacity assumption, and that the range of possible outcomes increases and rises. And if we are naturally going to have a higher average duration portfolio, even if we don't see a true market recovery, we should the blue line should move away from the dotted red line, which is sort of the lower band of revenue rates that we've achieved in the past. So a lot of potential for growth. It's a case of execution. We accept that completely, and it's for us to show that we can continue to deliver the 3-year plan. Now, moving quickly to the macro, spending a couple of minutes on this. This is I like this chart a lot because I've been plotting it for over 10 years now, which is to show the renewable generation. So page 9 now, the renewable generation as a percentage of demand. And while you often see or think of a nice stable line in terms of what renewables should achieve, the reality is very different. On moment by moment, it can generate basically about twice what it's expected to at one moment in time. So that really defines the need for BESS or for storage. You need to infill, right? So what's really interesting is that obviously the upper edge goes up with increasing penetration of renewables. The bottom edge hardly does at all. So it's still possible, however much renewable capacity you've got, to generate next to nothing. So you need to really replace and fully replace the missing generation if it's not there, and to absorb the generation if it's there in spades. And so that really defines the peak power requirement. And it's a question of what duration, amount of time, how long those effects might go on for. A super strong storm like we had last weekend, or a very weak period for a prolonged period as well. So that's the positive, and the need is there because the renewable capacity is going to grow very sharply, mainly in offshore wind, between now and 2030. There's a strong ambition to do this from Labour. We don't, for all the politics that goes on out there, there are very few alternatives for this country. We don't have the benefits of lots of coal or gas to benefit from. We've got to move away from fossil fuels, even from a political perspective, geopolitical perspective, I strongly feel. But of course, the decarbonisation agenda is also there. And I also sincerely believe that the deflationary aspects of solar, wind and storage will drive down electricity prices in this country long term once subsidies roll off, and if balancing is done well. Now, on to balancing. Obviously, batteries have not been well used in this country. Despite having 6,000 megawatts of peak power, we never are dispatched at more than a few hundred megawatts. That's not because we're not needed. It's because gas is being used instead. And it's because the systems and the regulations have not been in place to do that. So moving to the next page, and talking to this briefly, what is a skip rate? It's 1 minus the utilization rate. Why is a battery skipped? A skip is when a battery is offering itself to the system competitively at the best price, but not used. That is a skip. And that's in the context of the balancing mechanism. So the balancing mechanism is where a company called NESO, National Energy System Operator, used to be part of National Grid and used to be called NGESO, trades power with assets available to them, batteries or gas, to make sure that any imbalance in supply and demand is traded away to make sure the lights stay on. That's basically what they need to do. And they have not been using batteries to do this because they have not been able to see into the batteries and assess what state of charge they have, how much energy they've got in them. So that's a regulatory change. I'm pleased to say that yesterday, Ofgem announced the rule change to ensure that all batteries are obliged to report their energy levels, state of charge on an ongoing basis. Of course, we wanted to do this for years, but this rule change takes time. It takes negotiation with alternative technology providers. Everybody has a say, so it's taken a couple of years to get to that point. But now there's a potential for that to be implemented. It means that batteries can go head to head with other competing technologies at the level of capacity they've got. The other big change that's also happening, we plan for this month, I hope it follows through, is the full automation of the BM, of the balancing mechanism. To date, it's been traded by human beings, reading information thrown at them, and they have very long shifts, 8 to 10 hours, trying to balance the system and keep the lights on. It's very difficult to do. We have to accept that. And the automation of this moves away from human beings to trade energy, both at a national level and across bottlenecks and networks. And that should really also drive a better seamless system. But it's the implementation of this key rule change, the ability to see into a battery's energy, stored energy, that will really help the NESO to use batteries well. So we're hopefully on the cusp of seeing the rising revenues, which is what's reflected in forecast curves, even if those curves have drifted down over time. So we look forward to that coming through. That's the promise. We're fighting hard behind the scenes to make sure all these changes come about, speaking with government, Ofgem, and NESO, of course. Another macro quick point, page 11, is the fact that as you get more renewables, that overgeneration happens more and more, per the chart I showed you a little while ago. Without lots and lots of batteries installed, you get lots and lots of need to power down renewables. That powering down is called curtailment. But these renewables only power down when they're paid to do so because they're earning subsidies on their ongoing income. And so, apart from the latest contracts which force them to power down if there's a prolonged negative price period, by and large, lots of renewables remain online, and that leads to negative prices. These are forecasts from Modo. I don't think there's a source, and this is Alexon now. Okay, and the forecast for negative prices over the longer term. Oh, sorry. No, sorry. My apologies. I'm used to another chart that shows a projection for this. This doesn't have a projection in it. This is historical data provided by Alexon, which is the settlement body that sits within the control room, NESO. And they show that as of end of last year, cumulative negative pricing of 1,000 half hours. The projection that Modo has shown in the past, and others too, is that we get to 1,000 hours, so a doubling of this in the next 3 years. Sorry for misquoting the chart. But hopefully that's useful to show that this is an ongoing issue that's not going away due to the amount of renewables coming on. If we move to page 12, quick catch-all chart showing our positioning in the market. Our capacity is shown there in dark blue as of the end of 23. Then 24's increased, and this year's to date capacity. And we're the largest player by over a factor of 2. There are emerging players who are building large batteries out there. There's a need, we're at 6,000 megawatts as a fleet, a national fleet. There's a need by government to get to over 20 gigawatts by 2030. So there's a lot of room for growth. And the average duration of batteries, we feel, batteries or storage in general, it needs to go up from its current levels of less than 2 hours on average towards probably about 10 to 12 hours at least to cater for well over 99% of instances where where there's potential imbalances and excess or under generation of renewables. So hopefully that's a useful catch-all. Moving to the next page again, page 13. This shows our portfolio. On the right-hand side, you can see the fleet. It's an extensive fleet in lots of different places to deal with imbalances all over. Because the network is such that it was built out to meet to transmit generation, which was put in places where fossil fuel plants and nuclear plants have been in the past, and not where renewable generation is being installed today, there are bottlenecks emerging. And they emerge mainly from the north, up in Scotland, where you've got fairly significant constraints, bottlenecks, and the power needs to move south. A lot of talk about the need to expand networks, especially from various pundits out there. And the reality is that that's true. But batteries do a phenomenal job of mitigating that by creating effectively reservoirs of energy either sides of constraints that can be shifted when those constraints aren't in place. In other words, when the power that needs to flow across the constraint is below the size of the limit of that constraint or bottleneck. So that's exciting for us to have a fleet of this scale and across so much of the country. The charts in the middle of the slide are the ones that we're building out incrementally. We're adding about 65% capacity with just 5 projects, having had a fleet of 29 projects. So it's a big change in terms of scale. And 4 of our 5 projects are connected to the transmission network as opposed to the distribution network. So a big change, big upscaling. As you said, it's much cheaper batteries, allowing really attractive returns. And on the back of all of that, obviously, we've mentioned that free cash flow will be on the move. EBITDA will obviously therefore be on the move as well. But also our NAV, all things being equal, in other words, curves, all things being equal in that sense. So that's it. I'm very happy to take any questions. Hopefully that was useful. Hopefully you can see me okay still.
Yeah, no, that was excellent. We've definitely got some questions coming in, so I guess we'll sort of jump into those. But I think the first one, just really about the sort of augmentations. So are the sort of battery systems effectively modular? So how do you go from say 1 to 2, 2 to 4, 4 to 8, etc., etc.? Is it literally a case of you've got an existing site and perhaps stacking up or plugging in additional batteries? So how does that work? Because I understand it's a lot cheaper, effectively, adding this capacity than say building something from scratch.
It's cheaper and quicker. So yes, it is better in that sense. But of course, you're adding batteries behind existing capacity, which by definition means you're adding sort of the second hour, for example, and that second hour is never going to be the same as the first.
Mm-hmm.
But that first hour also required all the connection equipment to be installed as well. So there's a balance, and they have similar returns. So how do we add capacity? Well, if you think of a connection, behind every connection you've got transformers, inverters. Transformers take the voltage down to the site voltage that batteries like to operate at. Then you've got inverters that convert the electricity from AC power to DC, which is how batteries operate. In fact, all renewable equipment operates at direct current. So that's think of that as a unit of generation. That's how the network companies think of that. And behind of that, you've got the actual generation, which flows both ways in the case of batteries, that sits behind the inverter. So if you want to augment, you can just add batteries behind. Batteries like to be like for like. So you can take batteries from other inverters and put them behind some of the batteries that you're choosing not to move. And by doing that, you're freeing up quite a lot of inverter capacity because you're moving batteries that have been there and putting them behind and maybe turning half, you basically have, instead of a 50 megawatt 1 hour, you have a 25 megawatt 2 hour in that first step. And then if you then could use the freed up inverters to put brand new batteries behind those, you can effectively end up with you empty out one segment, basically put it behind the other one, and then fill up the empty segment with new batteries at 2 hour duration, and then you end up effectively with 225 megawatt sites with a 2 hour duration. That's one methodology. Another thing you could do is just derate your inverters. Don't run them at 50 megawatts, run them at 25. and you can do that when you've got plenty of space, and it's easier. And then you install brand new everything, transformers, inverters, and batteries, and that's the quicker, cheaper, not cheaper way, but quicker way, and easier if there are any sort of legacy technology issues. So if the inverters won't work with the latest batteries. So that's one of two of several ways, but hopefully a useful glimpse into how we think about things.
Yeah, that's sort of really helpful. So one question here just related to that. If you're sort of adding new capacity, let's say you're going from 1 to 2 hours, sort of how much cheaper is it to add that? But I guess it probably depends on the methodology.
It does a bit.
Mm.
And so we've in the past given a range that it costs between 100,000 and 200,000. This is quite old now. It was last year. Now we shared this, but 100,000 to 200,000 per megawatt hour to upgrade a site, all in, including civils and everything else, cabling. We're at the low end of that now, on average, and that sort of gives an idea. And the question then is, what's the incremental revenue? I think you get maybe at least £5,000 per megawatt hour bump in revenues just from the capacity market upgrade, if you can achieve that, and if you can get a new contract, because capacity market contracts are based on not just megawatts but also duration. So you can add contracted revenues fairly easily, and then it's a question of how much more can you make from trading the battery as well. So capacity market revenues are for those who don't know, are payments to generation that's fully dispatchable. So something that can be turned on when it wants to be turned on, as opposed to renewables, which are much more passive. So these are dispatchable technologies. Obviously, gas turbines get paid for that, and batteries get paid an amount as a percentage of the clearing price in the capacity market auction every year. That percentage is a function of your duration. So the longer duration, the more you get of that headline price. And so when you increase the duration of a site, you can, especially from 1 to 2 hours, you can actually double your capacity market revenues roughly. So that's hopefully that answers your question.
Yeah, no, that's excellent. Got a sort of, we're talking about contracted revenues, etc. There's a sort of question here.
Yeah.
And I sort of tend to think of PPAs more in the sort of context of the sort of renewable assets themselves. But there was just a question. It said, how important are PPAs for your sort of strategy, as it were? I mean, is that something that's relevant here?
A PPA thinking about our projects, you mean? Or
well, so purchasing or PPAs, power purchase agreements. I'm assuming that in my head that isn't necessarily something you would get involved with. But anyway, this question. So
like a PPA is ultimately a power purchase agreement, because you're just you're selling your power and someone else is purchasing it, so it's only one way. What we strike are what we call optimization agreements. Contractually, they're actually quite similar, and PPAs can have flaws. In other words, an off-taker, a buyer of the power, the other side of the PPA, can guarantee a certain level for you, and in return you'd pay a higher fee. It's very similar here. When we put a floor contract in place, the counterparty, and we've announced who we trading with, so in terms of floors, Statkraft and EDF, these counterparties are prepared to offer a minimum return or revenue level for our batteries at a floor level, and so if revenues are weak, we get protected. And in terms of duration, these contracts have got much longer, so they resemble PPAs really quite closely. And that's why I said at the very top that you can think of us as a source of capacity that needs to maximize the revenues per unit of capacity. And so we are trying to do exactly that. And rather than being a solar project or a wind project, we're a battery project trying to maximize the revenues that that we can earn through a floor agreement with a minimum return, and the upside is still preserved, and that's, I think, important.
okay, excellent. Probably sort of question related to portfolio here. Obviously, you've got a sort of arguably sort of concentration in a certain type of assets. But do you sort of try and
We do.
have a sort of range of modules, etc., so that you're not necessarily exposed to particular risks with one manufacturer, etc. You sort of introduce diversification into the portfolio that way.
We have diversification by individual projects. We have diversification by location. We have diversification, of course, by technology. Absolutely. Yeah, we do have different technologies on different sites. Um, there's some value in concentration to some degree. Obviously, you get a great focus from your counterparties if you give them enough volume. So there's a balancing act there. But diversification is obviously important as well. And we have absolutely diversified across a handful of different technology providers.
Okay, that makes a lot of sense. Related to all of this, we've got a question, sort of, do you have a view on some power price assumptions? I think what this is relating to is obviously in terms of, your estimated generating capacity and the sort of price you're using that. Presumably you need to utilize the sort of power price assumptions in those. There's been some sort of talk in the market that, actually there are a lot of assumptions about, for example, new nuclear capacity, etc., coming online on time and on budget, etc., and equally additional sort of renewable capacity.
Yeah.
And do you think that there's potentially upside in the sort of current power price assumptions?
That's a difficult one. First of all, just to be clear, we don't mind too much. We'll think too much about, or we do think about it, but not. It's not core to what we do to care about the absolute level of the power price. What we care about is the volatility in the power price, because ultimately
Yeah,
our batteries are trading the peaks and troughs in the day. That's number one. But in terms of the actual level of power prices, if you look at the chart that is showed, where we see more and more negative wholesale price instances, I suspect that the wholesale price will continue to drift down before it stabilizes. And that's why, and that's a function of the fact that renewables tend to generate together. Obviously different types in different places. So wind in a certain location will all generate together. Solar, of course, all generate together. And so that leads to instances where there's a lot of excess generation, and that can lead to negative prices or very low prices, and that is a driver of falling power prices. That's not necessarily a bad thing for us. Very low prices means we can sometimes buy or even get paid to charge our batteries before selling the power at another time of day. And of course, the instances where the generation is not there, the inverse of the excess generation, the power prices can go high. And to the extent that they do go high and there isn't renewable setting the price, the marginal generation there is likely to be still even beyond 2030 gas-fired generation. So the gas price does influence the power price much more now than it will in future, but it still will. So if gas prices are high, peak power prices and power prices in general will still be higher than they would be if gas prices were lower. But long term, there's a big question as to the balance between renewable capacity and battery capacity. And I can see a cyclicality here,
mm,
long term, where, if there's comparatively more battery overbuild relative to renewable generation, then batteries are helping out the renewables by creating demand for excess generation. And the inverse happens if you get excess renewable generation, build out, sorry, and that providing fodder, if you like, for batteries. So that they become, sort of opposite sides of the same coin. What we really need now, though, is for batteries to be able to take advantage of that volatile supply, and getting that skip rate topic fixed, so that the true need and volatility in the supply shines through without gas sort of dampening it because it's being prioritized out of necessity, because the systems and regs haven't been in place. With that going away, hopefully, I know, sort of moving away from the power price point, but just to reinforce that point.
yeah,
And what we really need is the focus should be really on the volatility of prices and the utilization of batteries.
excellent. As you were talking about the regulation, got a sort of question here. Somebody said, obviously, we've had the current government in place for over a year now.
Yep.
How do you rate their sort of treatment of the sector? And I guess related to this, do you have any sort of expectations of regulatory changes that might be coming through, and what might these entail? I mean, do you think they're doing a good job of regulation, or is it business as usual? Do you have a sort of
No,
view on that at all? Or?
there's an awful lot to unpack there. So at a macro level, Ed Miliband and Labour in general are pro Clean Power 30. They coined the phrase. They want to get to initially they wanted to get to zero fossil fuels by 2030. It's not realistic, but we will be almost all the way there by 2030, and a lot of that was already in train, right? We had a lot of offshore wind contracted through CFD auction rounds in the past, and they'll all come online as well as new solar and new wind onshore by 2030, and we should be at 70-80% renewables, depending on how you measure it, if you include biomass or otherwise. So we'll be at very high levels of renewables by 2030. To achieve that, Labour, it's not lost on DESNZ, the Department for Energy Security and Net Zero, led by Chris Stark, who was appointed by Ed Miliband, that to allow that capacity on without creating huge volatility and outage risk, you need the complement to that, and you need batteries. So they announced that they need a certain amount of renewables by 2030. Well, that was already well on the way, but they're the ones that stipulated that we need to go from the 4 gigawatts at the time that they came in, 4.5 to 20 something, and including the long duration energy storage, even closer to 30 gigawatts by 2030. That's a colossal increase. We're talking an increase of 4 or 5-fold of power, and in terms of batteries, total batteries or energy storage, at least 10-fold. So there's a massive need for this, based as shown in the chart we shared, and they've got behind that. And they've got behind that in different ways. They've initiated the legislation for long-duration energy storage really, really concretely. There was a huge bias against batteries under the Tories, under the DESNZ. To give you an idea, the long-duration energy storage plans in the beginning of 2024 resulted in a consultation being shared stating that batteries aren't even allowed to take part in long duration because, of course, they're just expensive, they degrade quickly, and they're only capable of doing short duration. That was the degree of misunderstanding about the capabilities of batteries at the beginning of last year. Come October last year, soon after Labour came into power, batteries, the minded to response on that consultation was, no, batteries are back in, and they're allowed, and we're going to go from 6 hours to 8 hours as duration. And then subsequent to that, there's been what's called an eligibility round. So projects that feel that they're capable of providing long duration have submitted themselves for being considered in an auction round that follows later this year. And about 80% of the capacity that's been made eligible are batteries. So huge sea change in terms, and it's also helped by lots of, pushing from our side and our peers, I strongly say, and also the fact that it's clear that batteries are being deployed elsewhere in the world and that the battery prices have fallen. So, it's like we're having been very early in this game as a nation. Back in 2016, the first enhanced frequency response auction was announced by the previous version of NESO. We've sort of started to lag, and deployment of batteries in places like the US, Australia, and Germany are starting to, and now Italy very soon is going to start overtaking GB, and hopefully there's a bit of egg on face and need to catch up. So very supportive. Appreciate that the technologies that get us there are solar, wind, and storage, and batteries in particular. So let's focus on the near term rather than the dreamy long term, which under the Tories included nuclear, hydrogen, more gas with carbon capture, which is an unproven technology as far as we're concerned, and other technologies which are really, basically expensive, difficult to prove, and have a long way to go to establishing themselves. So it's been very, very positive. Sorry, I dwelt on this point quite a lot, but it's been very, very positive. And of course, they've really supported and pushed the fixing of the system and regulatory issues as well that we've talked about, the skip rate issues. So, but very, very, very glad that they're on in power. The final one, sorry, you may have seen in the press that the National Wealth Fund, the new incarnation of the UK Investment Bank, has supported the build out through investment, the build out of 2 competing pipelines. You could say that's competition, it creates overcapacity. There's so much to build that I think it's a positive to see the government as an investor in this space therefore wanting to get the return, and unlocking capital for the sector. They've crowded in capital from others, basically. So that's very positive, because the government can now put pressure on the government. That's helpful. Not that there's that much more need. I think we're sort of pushing on an open door now, but we do need to see the results in better revenues.
Yeah. Okay. Couple of interesting points. You talked about the sort of colossal increase in sort of capacity that are needed, and of course, this is sort of replicated all over the globe, as it were. And we've seen sort of battery costs coming down, but if there's going to be all this demand, I guess, for batteries, what sort of impact is that going to have? And a sort of question we got related to that was just, what is the battery life? You were talking about sort of degradation.
Yeah.
Just thinking, how often have we got to replace these? What does that look like?
Great. So supply chain question, and then degradation
Yeah.
question. Yeah. So
Yeah.
supply chain, there's lots of capacity being installed, mainly in China, for batteries. So at the moment, there's probably an oversupply in China, despite the growth. And so pricing is favorable for that reason. There's also a lot of innovation. I think it's the cells that sit inside these very large batteries are getting larger, which reduces packaging, increases voltages. It just basically you're getting efficiencies, and obviously the throughput, the sort of asset turns, if you like, is of that old concept. The amount of the productivity of the equipment that's installed to make the batteries is improving as well. So all of that just brings prices down, and cost down as well. So supply chain issues we don't see at the moment, and we also have significant buying power. So we'd like to think that we're relatively favorably positioned. In terms of other equipment, whether it's high voltage equipment, transformers, connection equipment, switchgear, things like that, we again have pretty good routes to market. I think the bottlenecks mainly lie in the procurement processes of the network companies, which are quite selective and potentially unnecessarily rigorous in terms of the equipment they go for, which leads to much longer lead times for equipment for network companies than for ourselves, in non-battery equipment, if you like. Then coming to degradation, when you go longer duration, the amount of power you're getting through a battery drops. Right? If you double the duration, you halve the power, you halve the current and the power. So that improves the energy loss per cycle. That reduces the stress you put on the battery and increases battery life. The amount of time that you're going to spend fully discharging it per cycle goes down as well, because you're still going to have a preponderance of sub 2-hour discharge opportunities versus full 1-hour opportunities if you're a 1-hour battery. So your depth of discharge on average drops as well. And all that is basically kind to the battery. That means that as you go to longer and longer duration, the warranties that you're offered increase. So through the maturation of the sector anyway, warranties are extending. They started at 5, then 10, now 15 for even 1-hour batteries. We're getting towards 20 hours for 2-hour batteries and 25 to 30 for 4-hour batteries. That is clearly a wasting asset, but it's more akin to a wind turbine, a gas turbine, or not quite as good as a solar panel yet. But it clearly shows that batteries are maturing in a positive sense in regard to degradation and warranty lengths.
Brilliant. Guess sort of related to that, how easy is it to sort of recycle the batteries?
Very good question. The companies there are companies popping up all over, from the manufacturers themselves putting in. We'd like to nickname it urban recycling. It's urban mining. Sorry, urban mining. You're remining the materials from exhausted built equipment. But it is recycling, and there are those that now are willing to pay for kit. A positive development this year, to be honest, where you can get paid to remove kit from your site, which is a turn up for the books, given that our working assumption is that you don't get paid.
Yeah.
But it's not lost on the manufacturers that there's a really opportunity to recycle there, and both from the steel containers all the way down to the recycled material. The recycled material is called black mass because it's a black powder once it's been mashed together and processed, and that's the lithium containing material, and that has a real value. It's a traded commodity now.
Excellent. Just sort of conscious of time, we're sort of coming up to the hour. I'm sort of probably to sort of wrap this up, but I guess
Yeah.
to sort of close this off, just to tell us, I guess sort of why grid and why now?
So, why grid? We're the largest player. We've got a long track record. We believe we have been creative and will continue to be creative in terms of how we make money. We have an exciting um, build program now that will sort of cement our strong position as well. So we're taking advantage of the growth opportunity. The why now? I believe that and I'll speak personally here. The share price, I think, discounts the business's current cash flow, gross cash flow. Um, it does not discount any recovery in curves in revenue forecasts, and I don't believe it discounts any of the growth in the capacity that we're installing either. So none of the growth or recovery in revenues is discounted in the share price. If the growth was not discounted, but the recovery in revenues was, we'd be at NAV by definition. So we're at a big discount to NAV. So I think we're discounting today's revenues and forecast and cash flow. Sorry. And we believe that, we'll be on a journey upwards through a combination of capacity and recovery in revenues. We don't know. It's difficult to chart exactly where. We'd like to think that we've executed quite well in terms of our initial steps in our plan. We look forward to delivering the remaining ones and getting new projects to construction and alternative revenues kicked off. So we see a lot of upside. I'm personally a 3% shareholder of the business, and so have been and have invested incrementally through the last few years. So, hopefully that's convincing.
Excellent. Well, thanks for that. It's been really, really informative chat. As I say, very, very timely as well. So it's great to have you on this week. Hopefully we can get you back a year's time or something, and we can talk about how it's all going. Hopefully we've moved on again. So I'd say, thank you everybody. Once again, just got the disclaimer here, guys. If you can take a moment to read that and say it is important. And then I just wanted to tell everybody, I think we're back next week and we're going to be doing the sort of results from our Investors' Choice Awards. Hopefully you've all been getting your votes in for that. We're looking forward to posting that on that next week. But thanks once again, Ben, and wish you all a great weekend.
Thank you very much.
See you next week.